Hey everyone, I'm Ben Sweat from LevinPro HC, and I'm here with Matt Huber of Flagstar Bank. Welcome, Matt. Thank you for joining me today.
Thanks for having me, Ben. Appreciate it.
We're at the McGuire Woods Healthcare Private Equity and Finance Conference in Chicago, and would you please just start by telling me a little bit about your history with Flagstar over the course of your tenure there, and then maybe what Flagstar's mandate is, what kind of loan sizes you're looking to put out, and what healthcare sectors you're looking to do business in.
Sure. Short answer to a long question. No. So Flagstar Bank is kind of the new Flagstar. We're about a $90 billion regional bank that is going through a metamorphosis, right? We're the amalgamation of Signature Bank, New York Community Bank, Flagstar Bank, and we have an entire new executive team, entire new board of directors in the past 2 years, and they're doing a great job. They're turning this into a real commercial bank. And fortunately for me, healthcare is a focus. So historically, I started the group at Signature Bank 4 years ago, and we were very real estate focused. A lot of seniors housing, a lot of behavioral. We've since expanded our reach into the healthcare services sector. So we're doing a lot of cash flow and leverage lending. We've hired some folks to help support that effort. And it's not to say we're not doing real estate anymore. It's sticking to that knitting, but we're going to diversify the portfolio. So we're going to try and balance it. We did a great job last year. Very proud of the team. We were able to hire a handful of people to help us with our strategy. And we've closed about $600 million in new transactions last year. Almost half and half, real estate and cash flow. Very proud of that. We've got a great team. There's almost 20 of us that are involved in this. The portfolio is about $1.5 billion. And so in the services sector side or the cash flow lending side, we're really agnostic as to the type of healthcare companies. We want them to be strong companies. We want them to be a little more mature. We're not really looking for that venture capital, right? So EBITDA's in that 10, 15 million or larger range. We've been participating with a lot of great bank partners, and this year has been very active. It's been a little stressful. Not going to, change is hard, but the competitive landscape in the last 12 months has dramatically increased in all aspects of lending, in my opinion.
Yeah.
I'm sure you're seeing that with your other friends, right?
Absolutely, on the seniors housing and skilled nursing side, and then just liquidity pouring into the healthcare services space. Could you tell me a little bit more about like the competitive landscape you're seeing in the healthcare lending world, and maybe how terms, prices, anything else are changing as a result of that?
Sure. Yeah. We on the real estate side, we do nursing homes, we do senior housing. We're seeing competition increase their loan to value sizes. So, we've kind of stuck with that 75% loan to value on an acquisition or a recapitalization, where other folks are doing 80, and some covenant light stuff and limited recourse. And so we're seeing a pullback in some of the structure, which is shocking because it's happened so quickly in the last 12 months. On the healthcare services side, where the cash flow side, if we're going to take on some additional leverage, right? Typically you want to keep 3 times senior, 4 times all in debt to EBITDA. If we exceed that, it's considered a leveraged loan, but we expect to be compensated for that additional risk. That's not always the case. Sometimes we're seeing the same pricing for a leveraged deal that we're seeing for a fairly unlevered deal, or covenant light, right? From my perspective, the giving up on price or giving up on spread is a little bit easier than giving up on structure, right? We're regulated institutions. We're loaning you your grandma's money. We're not, it's not the bank's money. So the regulators, they're not focused on our profits. They're focused on the quality of our loans. And so,
which is maybe a good lesson to have learned from the last 5 years in general in the banking industry.
Fair comment, Ben. I mean, we went into the pandemic with a portfolio that was not over-levered. So most of our clients actually did okay. I mean, it was a tough time, let's face it, but they didn't have the financial problems that I know some other folks had that were a little higher levered, right? So we're going to stick to our kind of call it conservative lending if that's the expression, I don't know. I think we're going to stick to more traditional structures, and we really want companies and individuals who have been there and done that. You know, we're not taking flyers on the new deals or the new people. We want to be part of, you know, healthcare is such a big industry. There's so much capital that's necessary just to run this industry. And we want to be part of the folks in the middle ground, right? That are a little bit above middle market, but a little below that kind of rated corporate.
Yeah.
And that's a big sector.
Well, it sounds like then you're more sector agnostic, and so
Yes.
you're not chasing the new hot sector. But if you were to favor maybe one or two new sectors that you'd like to do more business in right now, what would those be, and why?
Well, I mean, no matter how it pans itself out, technology will continue to drive innovation in healthcare, right? Whether, I know everybody talks about AI, but AI is only one aspect of technology. And so I like technology in healthcare. I like seeing how it can improve outcomes, how it can improve and streamline reimbursement capture. So I like technology. But at the same time, there's still companies out there inventing and developing new services in the operating room, and they're providing guidance and services for the doctors and the surgeons. I think that's core business.
Yeah.
You know, and I think that's the place to be.
Yeah.
Yeah.
And patient-centric, which will be important going forward with demographics, perhaps.
Yeah, absolutely. I mean, the baby boomers, who I think are 82, the oldest is 82 this year, they're very demanding people. They're very demanding people. They want what they want when they want it. The question is, are they willing to pay for it? I think they will. Not everybody, but I think the numbers are so large that there's plenty of opportunity there.
Yeah.
So, yeah.
Well, last question, what would make a successful McGuire Woods conference for you?
Well, you know, I think Flagstar Bank is still getting on the map, right, as a known quantity or a known entity for lending into this space. So having more opportunities to participate or lend into the sector would be ideal, right? And getting to know the movers and the shakers in this world. You know, this is our second time coming to McGuire Woods. It was great for us last year. I'm hoping it's super for us this year. So it's connections, it's opportunities. Yeah.
Well, I'll let you go make some new connections, but thank you for stopping by and talking with me.
My pleasure. Thanks, Ben. Appreciate it.